Alright guys, in this video, it's all about defining securities. Now, when it comes to securities, stocks and bonds are the most basic securities and are the building blocks of most investment strategies. To be clear on the definition of a security for the exam, you want to remember that a security is an intangible financial asset that may be bought, sold, or gifted between persons. It may be represented by a paper certificate or held in an electronic record. Now, here's a list of securities you want to keep an eye out for that may appear on the SIE exam. You want to be familiar with stocks and other equity securities, bonds and other debt securities, mutual funds, limited partnerships, options, and municipal backed securities. Now, when it comes to recognizing what's not a security, a few things you want to keep in mind that are not securities would be commodities. You want to think commodities as like oil, orange juice, groceries you can get out the store. Precious metals like gold, silver are not securities. Currency, so actual money. Futures, which are derivatives from commodities. And a personal residence are examples of what's not a security. Now, as for the two most common types of securities that you'll see on the exam are stocks and bonds. When it comes to stocks, you want to remember stocks represent equity, which means that the investor holding the security has an ownership interest in something, usually a corporation. When it comes to bonds, bonds represent debt. They are like an IOU that an investor holds. The investor, which would be you, is owed something, which is money, and the person that owes, which is often the corporation issuing bonds, will have to pay according to the terms of the IOU. So let's say there's a set rate that they would pay you annually every year, as long as you are invested into their bonds, like an IOU. So if you see a couple questions like this on the exam, another term for stocks and bonds is, you remember stocks represents equity, bonds represent debt. And then the second question, which of the following is not a security? Which one do you think is not a security? You'd want to go with orange juice futures. Though that's a commodity, not a security. Now, of the equity securities, common stocks are the most common. You'll see more questions on common stocks than any other security on the exam. So an investor that holds common stock owns a piece of a corporation. It's important to remember all corporations issue common stock. Now, purchasing shares of common stock in the company allows individual investors to participate in the company's success. Investors can benefit by selling shares that increase in price, known as capital appreciation. and by sharing in company earnings through a distribution of profits called dividends. Each share of stock entitles its owner to a portion of the company's earnings and a vote in major management decisions. In most corporations, the stockholders regularly elect individuals to a board of directors to oversee the company's business. Now, with common stocks have a few classifications. Common stock can be classified as authorized, issued, outstanding, or treasury. Now, when it comes to common stock that's authorized is just the number of shares the company is allowed to issue to the public in order to raise capital. It is a decision made by the founders of the business at the time the charter is written. So authorized is just a limited amount of shares a company can legally sell to the public. You could think the total number of seats a stadium is permitted to sell and hold. So first, shares get authorized to be sold, and then you have issued. Issued just means shares that have already been sold. Issued stock is authorized stock that has been sold to investors. Those investors have bought the stock and the company has received the money. Authorized but unissued stock does not carry the rights of issued shares and is not considered in determining a company's value, which is known as a market cap. So issued is what have been sold. Authorized was the amount that is approved for sale. And then outstanding stock includes all shares that a company has issued and that are in the hands of the investors. So just think whatever is in the public's possession, whatever shares that were sold, shares that were issued, are still currently out there in the hands of the public. Currently in the hands of the public is outstanding shares. And then you have treasury stock, where treasury stock is a stock a corporation has issued and then later bought back. The corporation can hold the stock indefinitely or can reissue it or even retire it. The treasury stock does not carry the rights of outstanding common shares, such as voting rights and the rights to receive dividends. For that reason, treasury stock is not considered in determining a company's value. So treasury is just shares that were once sold to the public, once in the hands of the public, that the company decided to buy back from the public. And they can later decide to reissue those shares they buy back, or they can retire them completely and issue new shares. So if you see a couple questions like these, a corporation issues stock in order to raise capital, and there's a set number of shares they're allowed to sell to the public, which are known as authorized shares. And then you have ABC Corporation has issued 300,000 of its 1 million authorized shares. How many shares does ABC Corporation have outstanding? The answer would be 300,000 shares. because issued means already been sold to the public. And what's sold to the public means it is in the hands of the public, meaning they are outstanding shares. So they issued 300,000 of the 1 million they were allowed to sell, but they didn't sell the full 1 million. They only issued 300,000, and that 300,000 is what is outstanding. So now, with raising capital by issuing stocks is what leads to market capitalization. One of the regular ways of identifying types of common stock is by the size of the corporation. This measurement is called market capitalization. Another way is based on the price of a share of stock, where very low price stocks are called penny stocks. So, a corporation's market cap is determined by multiplying the number of outstanding shares by the current market value, CMV, of a share. The first size of a corporation to remember to determine its market cap are large cap stocks. Large cap companies are the largest companies. They can be rapidly growing technology companies or big, long established firms. These tend to be the companies with names that you're familiar with. The stocks of large cap companies that have a long history of steady dividend payments are often called blue chip stocks. And with large cap stocks, they have a market capitalization in excess of $10 billion. So anytime you see a question mentioning a well-established company, a company that has a history of paying dividends, that's how you know it's large cap. And another name for it would be blue chip. Now, when it comes to mid-cap stocks and small-cap stocks, with mid-cap stocks, they tend to reflect characteristics of both small and large caps. And with mid-caps, the stock of mid-cap companies have a market cap from 2 billion to 10 billion. So remember, 2 billion to 10 billion for mid-caps. And with small caps have market capitalization of 250 million to 2 billion. And now you have penny stocks. What to remember with penny stocks, you remember a penny stock is an unlisted, meaning not listed on a US stock exchange. It's an unlisted security trading at less than $5 per share. So you could think pennies are less than $5. With penny stock, equity securities defined as penny stocks are considered highly speculative. So you want to think high risk with penny stocks. In this light, the Securities Exchange Commission, SEC, rules require that customers be given a copy of a risk disclosure document before their initial transaction in a penny stock. So remember, penny stocks require risk disclosure documents. The broker-dealer must receive a signed and dated acknowledgement from the customer that the document has been received. The penny stock disclosure document fully describes the risk associated with penny stock investments. And you want to remember, regardless of activity in the customer's account, if the account holds penny stocks, broker-dealers must provide a monthly account statement to the customer. The account statement must indicate the market value and number of shares for each penny stock held in the account, as well as the issuer's name. When it comes to cold calling, so contacting potential customers and not existing customers, a broker-dealer representative may contact a potential customer about purchasing penny stocks. This would be a solicitation to buy, such as those occurring during a cold call. The SEC rule states that in this situation, the representative must first determine suitability with potential customers on the basis of information about the potential customer's financial situation and objectives. The potential customer must sign and date this suitability statement before any initial penny stock trades, meaning buying and selling, may be placed. In addition, the broker-dealer must disclose to the potential customer the name of the penny stock, the number of shares to be purchased, a current quotation, so the current price, and the amount of commission that the firm and representative will receive. So suitability is required for potential customers. As for established customers are exempt from the suitability statement requirement, but not from the disclosure requirements. What's considered an established customer? An established customer is someone who has held an account with a broker-dealer for at least 1 year. So you want to keep an eye out for a customer for at least 1 year is considered established, or has made at least 3 penny stock purchases of different issuers on different days. Moving on to rights specifically of common stockholders. Now, a stockholder, once again, is an owner of the corporation. As an owner, the stockholder has certain rights, and this is specific to common stockholders. Now, one right you want to remember stockholders do not have, one right stockholders do not have is the right to dividends. You don't have any rights to receive dividends because the board of directors are the ones that decide to declare dividends. But you do have a right to vote as to who sits on the board of directors. So voting rights is the first right you want to remember. Common stockholders have the right to vote for who sits on the board. Frequently, it is not possible for the stockholder to attend the stockholder meeting to personally cast a vote. An absentee ballot, known as a proxy, is made available for those stockholders who want to vote but cannot attend the shareholder meeting. Those voting by proxy can generally do so by mail or online. Common stockholders may also be asked to vote on very important issues like the issuing of new shares or a major change in the corporation's direction or identity, like a name change. And then you have preemptive rights, where if a company issues new shares, current owners have the right to buy them first to maintain their percentage of ownership. Now, when it comes to how dividends are paid out, dividends are paid out in either cash, stocks, or products. But the main two on the exam that would be asked about are dividends in the form of cash and in the form of stocks. When it comes to cash dividends are normally distributed by check if an investor holds the stock certificate, or they are automatically deposited into a brokerage account if the shares are held in a brokerage account. So held by in the name of the firm they open the account with. When declared, cash dividends are typically paid quarterly and are taxed in the year they are distributed. In questions involving a cash dividend from stock, assume a quarterly dividend unless the question says otherwise. And another thing with cash dividends may be taxed as either non-qualified, meaning taxed at the investor's ordinary income tax rate, or qualified. The maximum tax rate on qualified dividends is specified by the current IRS tax code and will depend on the investor's income tax bracket. So the higher the income tax bracket, the higher the tax on qualified dividends will be, up to the specified maximum. And then you have stock dividends. With stock dividends, a company may want to reinvest its profits rather than pay cash dividends. So in the place of a cash dividend, the board may declare a stock dividend. Many growth companies do this to use the cash for research and development. In a stock dividend, the company issues additional shares of its common stock to its current stockholders instead of cash. The result is that the shareholder now owns more shares after the distribution, but the cost per share is adjusted downward, so the total cost of shares owned by each shareholder does not change. The stock dividend itself is not taxable, but the adjusted cost per share, a new cost basis, will impact any capital gains realized when the shares are sold. The shares for the stock dividend come from the authorized shares or from treasury stock. Now, it's important to remember the timeline of how dividends are distributed. The process of getting paid follows a strict chronological order, which can be remembered by the acronym DIRP. So it's important to remember the order of how dividends are distributed. First, in DIRP, you have the declaration date. The declaration date is when a company's board approves a dividend payment. It is recognized as the date the dividend was declared. At this time, the board would also designate the payable dates and the dividend record dates. So this is just the date the company goes, hey, you know what? There's going to be some dividends to be paid out. We're declaring dividends will be paid. That is the declaration date. And then you have the ex-dividend dates, which is based on the dividend record date. The final, and then you have the ex-dividend date, which is based on the dividend record date. With the ex-dividend date, you want to remember it is normally the same date as the record date. Because most trades settle regular way, which is 1 business day after the trade date, a customer must purchase the stock at least 1 business day before the record date to qualify for the dividend. Or said another way, to receive the dividends, the stock must be purchased before the X dividend date. Remember, if the stock is purchased on or after the X dates, the new owner has purchased the stock X, meaning without the dividend, and is therefore not entitled to receive it. And then you have the record date, meaning the stockholders of record, those who own the stock, as of the end of the day on the record date, receives the dividend distribution. So they only distribute dividends to owners on record. So you want to make sure you're on that record before the X dividend date. Because if you purchase on or after the X dividend date, you're purchasing stock without the dividend. So they only pay dividends to those they see are owners by the record dates. And then you have payable dates. On the payable dates, the dividend dispersing agent sends dividend checks to all stockholders whose name appears in the records as owners as of the record date. The investors are taxed for the tax year the dividend is paid based on the payable date. Now, as you know, once again, as stockholders, you do not vote on dividends being paid out, because just think you would always want to vote for dividends to get paid. The board of directors chooses if dividends will be declared, but you can vote as to who sits on the board. Now, when it comes to voting, you have statutory voting and you have cumulative voting. With statutory voting, it allows a stockholder to cast 1 vote per share owned for each item on a ballot, such as candidates for the board of directors. A board candidate needs a simple majority to be elected. So with statutory voting, you get 1 vote per share for each open seat. So let's say with statutory voting, assume that a shareholder owns 100 shares. With statutory voting, the shareholder may use a maximum of 100 votes for any 1 seat on the board. So a shareholder owns 100 shares with statutory voting means they can put 100 votes on seat 1, 100 votes on seat 2, and 100 votes on seat 3. With cumulative voting, under cumulative voting, instead of evenly distributing their votes, under cumulative voting, the shareholder may allocate all 300 votes any way they choose. So it could be 175 on 1 seat, 50 on another, 75 on seat 3, if it's cumulative. Or cumulative, they can do 300 votes on seat 1, 0 on seat 2, and 0 on seat 3. It doesn't have to be evenly spread out with cumulative, but statutory voting, you could think, is evenly spread out. We talked about voting by proxy. If you can't physically attend the meeting to vote, you can vote electronically or by mail. So with common stockholders, you have preemptive rights You have rights to vote on the board of directors, and you have the right to freely transfer shares. Common stock is freely transferable to anyone who wants to buy it or receive it as a gift. Shareholders have the right to sell or give away their shares without the permission of the corporation. Without this feature, there would be no stock markets. And common stockholders also have the right to information. So just think any major changes of the corporation, common stockholders have the right to know that information. So you want to think financial transparency, disclosure access when it comes to rights to information. You're not involved in any day-to-day operations, but you do have the right to know what's going on. So when it comes to benefits of ownership, equities is ownership. Stocks represent the best path of many clients to achieve their long-time financial goals. Historically, stocks have provided the best growth against inflation out of any major asset class. With equities, investments are not without risk, like any investments. But as far as benefits, there are several financial benefits offered by ownership of common stocks, such as growth, which is known as capital gains, income, and limited liability. As far as capital gains is an increase in the market price of a security. And historically, owning common stocks have provided investors with returns much better than the inflation rate. So it has great inflation protection, you can think, or a hedge against inflation do common stocks have. Most investors with a long-term investment horizon have included common stock in their portfolios as a hedge against inflation. Of course, you want to remember common stocks and stocks in general, prices can decline, particularly over the short term. As far as income, many corporations pay regular quarterly cash dividends to stockholders. Dividends are once again declared by the board of directors and may increase over time as profitability increases. Dividends, which can be a good source of income for investors, are a major reason many people invest in stocks. It also has, like I mentioned, limited liability. One of the most important features of stock ownership is limited liability. In the event of a corporation's bankruptcy, when corporate assets are not adequate to meet the corporation's obligations, a shareholder's personal assets are not at risk. One cannot be forced to sell any personal assets to help pay the debts of a business. So you have limited liability. The risk of ownership, you have the chance that a stock will decline in price is one risk. A stock's price fluctuates daily as perceptions of the company's business prospects change and influence the actions of buyers and sellers. Investors have no assurance whatsoever that they will be able to recoup the investment in a stock at any time. When investors wish to sell their shares, the price may be higher or lower than when the shares were initially purchased. So price fluctuation is a risk of ownership, also known as market volatility. So just think how the market goes up and down, changing in price, right? Though market volatility is a risk, there's always a way to make it work for you, which is simply staying invested. You never want to time the market. You just want to stay invested in the market. Common stocks is often for long-term investors. And when a company goes bankrupt, common stockholders get paid last. They are lowest priority at dissolution. And then you have preferred stocks. With preferred stocks, preferred stock is a type of ownership that behaves more like a claim on the company's cash flow rather than full control of the business. A good way to think of preferred shares is that the owner of preferred shares owns an interest in the cash flow of the company. The rate of return on a preferred stock is fixed rather than fluctuating like the rate of return on a common stock. A preferred stock's annual dividend represents a fixed rate of return. This is important for income-oriented investors. So with preferred stocks, you're not keeping up with inflation rates, you're not participating in growth. You're more focused on fixed rates and income, not fluctuating. A preferred stock is identified in part by its fixed dividend. This dividend is stated as a fixed dollar amount. So $4 preferred pays $4 per year, or as a percentage of par, such as 6% preferred pays 6% of the stock's par value. Always assume preferred par value is $100 unless stated differently. When it comes to types of preferreds, you have straight, cumulative, callable, convertible, adjustable, and participating. Now with straight, also known as non-cumulative, straight preferred stock has no special features beyond the stated dividend payment. Any missed dividends are not paid to the holder. There's no requirement for the company to make up missed dividends. So you want to think with straight preferred, company just keeps moving straight ahead. Any dividends that could have or should have been paid in previous years will not be made up. They will not go back to pay out old dividends. They just move straight forward. Then you have cumulative. With cumulative preferred stock, it accrues payments due to its shareholders if dividends are reduced or suspended. This means that the unpaid dividends add up until paid. So you want to just think with cumulative, any unpaid dividends that were missed in the past actually pile up. They accumulate. Another word you want to keep an eye out on is arrears. Any missed dividends from the past do get paid out. So just think the corporation will go back around and pay out any dividends missed. And they would pay all dividends owed with preferred before any common stock gets paid. So always remember, preferred shares dividends will always get paid before common. Whether it's straight, cumulative, callable, convertible, adjustable, participating, preferred gets paid before common. Cumulative, once again, pays any missed dividends. And then you have callable. Callable is when corporations often issue callable preferred stock. which a company can buy back from investors at a stated price after a specified date. The right to call the stock allows a company to replace a relatively high fixed dividend obligation with a lower one when the cost of money, which is interest, has gone down. So you want to think whatever rates a corporation promises to pay a bondholder, if they want to lower the rate they promise to pay back, they can call these preferred stocks back and reissue at a lower rate. So you want to remember, callable always benefits the issuer, not so much the investor. They can lower the promise of their rate that they would pay annually or quarterly. And then you have convertible. You just want to remember convertible if, let's say, an investor decides they want to participate in growth more than receiving the income at whatever rate was set by the company. Maybe it's not even a high rate, and they rather participate in growth rather than receive income at that rate. They can convert their preferred shares into common shares, allowing them to chase higher growth. And then with adjustable rate preferred, some preferred stocks are issued with adjustable or variable dividend rates, such dividends are usually tied to rates of other interest rate benchmarks, like Treasury bills. So just remember the rates of adjustable preferred rates just makes adjustments based on market benchmarks. So the rates fluctuate with adjustable rate preferred stocks, unlike normal preferred stocks. Remember, callable would have the highest premium. When it comes to preferred stocks benefits and their risks, although preferred stock does not typically have the same growth potential as common stock, preferred stockholders have some advantages over common stockholders. You have dividend preference, which means, once again, the board of directors pays dividends of preferred shares before they pay any dividends to common shareholders. And that's the same thing with priority at dissolution, bankruptcy, preferred shares gets paid out before common shares. Risk of owning preferred shares, you have purchasing power risk, meaning that inflation can hurt the value of your dollars invested in preferred stocks. You also have interest rate sensitivity risk. When interest rates rise, the value of preferred shares declines. You have decreased or no dividend income because the board of directors determines what dividends get paid. And priority at dissolution, though preferred shares get paid out before common shares, preferred shares get paid out after debt. Secured and unsecured debt comes before preferred stocks. Why would you include preferred stock in a client's portfolio? If they're looking for fixed income from dividends or prior claim ahead of common stock.